So what's the cause of all this? Well, the major cause, as both of them have already said, is the property bubble. I think that there's little doubt now that there was a bubble in property prices, and I would put that to a large extent at the door of the Federal Reserve. When they reacted to the recession following the collapse of the tech bubble and then the 9/11 events, they kept interest rates low for a long time, and I think that's what sparked the bubble and helped fuel it. Now, one interesting question is, at what point should we have realized that there was a bubble? Now, Jeremy gave this data that if you look back in the US, you find that there's no year that the average across the entire country has fallen since the Great Depression. So there was about 70, 75 years of data suggesting that house prices on average couldn't fall. And that's the data that was used by the rating agencies and many others. Now, the interesting thing is that about the same kind of time, 2004, 2005, 2006, if you'd gone to the newsstand and bought a copy of The Economist, what you would have found is many articles suggesting that house prices were getting too high and there might be a bubble. And by the time 2006 came, they were definitely saying that. And they used a number of very simple metrics. But of course, if you look outside the US, it's quite clear that there were a lot of property bubbles. Jeremy mentioned briefly Japan. I'll talk about that in a minute. But property prices in Japan fell 75%, roughly speaking, over 15 years. There were also these huge bubbles in Hong Kong and Singapore and many other places in Asia. So there were a lot of places where property prices had fallen, but not in the US. And one of the big problems is, how do we extrapolate evidence from other countries to our own situation? So in any case, we had the bubble, it started to burst. What happened then? Well, property prices started to go down and default rates started to go up on the subprime. Now, that's a problem, but relative to assets in the US, it's not such a huge problem in terms of dollar amounts. Now, back in July of 2007, people suddenly realized that these amounts that were falling, these subprime, they were much riskier than people had realized. And so they started to rebalance their portfolios. Now, there was a period of a few days in July when prices of AAA tranches of subprime securitizations fell dramatically. And that's when things started to go bad, because these were assets which were thought to be extremely safe, not much different than Treasury securities, and people had relied on that in the AAA tranches. Now, they fell dramatically, and the question is, what was happening then? Was that because we were learning about default rates, or what? Now, my own view is that something somewhat different was happening. There was some learning about default rates, but in fact, what I think happened was that the liquidity capacity of these markets, which were fairly thin and illiquid, was overwhelmed, and the prices fell when it was overwhelmed. Now, normally you'd say, it'd be like Finance 601 today, well, if the prices fall too low, people should go in and arbitrage that and hold them, and then they'll make a profit. Now, the problem with this was that the link between fundamentals and prices had been broken, and it was broken for long enough that it became a risky arbitrage. Now, Jeremy was describing how the investment banks were doubling down. They thought that these assets were underpriced, so they bought more of them. Now, of course, what happened was the price went down further and caused a lot more problems. Now, the reason that I think that this was a problem with the arbitrage pricing going wrong was it wasn't just subprime AAA securitizations that had problems. Within that period of a few days in July, many other securitizations with completely different fundamentals also had problems. So commercial-backed securitizations, the AAA tranches of those also started to fall. And credit default swap securitizations on the riskiness of firms, they also started to fall, and the co-movements spiked dramatically. So the problem was the prices got out of line, and they have stayed, in my view, out of line because it is a very risky arbitrage, and that's exacerbated the problems considerably. Now, as we saw, there have been these effects. So first of all, the interbank markets froze, and so the central banks started to try and unfreeze them. They cut interest rates. They did a lot of things. Now, it wasn't really until this March that things really got serious in the sense that we started to see failures. And Bear Stearns was a very interesting case. I think the Fed probably did the right thing there. They didn't know much about their positions, and they were faced with a weekend to try and find out it's not enough. So what they did was play it safe. What they were worried about was contagion risk. That's the notion that if Bear Stearns had failed, a lot of other places who had claims on Bear Stearns would have suffered a problem. They might have started to sell assets to try and deal with some of those problems. That would have caused asset prices to fall further. And we get into this meltdown, and things go bad with a whole chain of bankruptcies. Now, after they rescued Bear Stearns, they gave access to the other investment banks. And as is well known, I think, the quid pro quo for that access was that the New York Fed got to put examiners in there, and they were allowed to look at all the books. So when Lehman came along, they knew pretty much what their positions were and what the effects of allowing them to go bankrupt would be. So this time, they were able to let them go without too much risk of systemic risk of this contagion that we're talking about. Now, Fannie and Freddie, Joe talked a lot about that. My own view is they had to act there. That is such a major player in the property markets. They needed to stabilize that, and what they did there was appropriate. I think one of the things that I learned is that Thane is a very smart man, and on Sunday, when he realized that there may or may not be a deal done with Lehman, what he should do is to prevent Merrill Lynch being on the block this week is to just go and see if anybody wanted to buy them. And they did, and he got a very good price for Merrill. So this week is AIG. Now, I've been teaching all day, so I don't know exactly what happened. Jeremy seems to be more informed. I don't think they've done a deal from what he said and from what I understand, but it hasn't been finalized. So we'll see what happens with that. Again, the Feds are going to be worried about this contagion risk. I'm not sure they know enough about AIG's positions to make a snap decision. And usually in those positions, they do the risk-averse thing, which is to bail them out or to make sure that there's no spread. Now, is this the end? Well, I don't think so. I think that we will have problems going forward in the US. So if you look at credit default swaps on Citigroup, they're beginning to rise dramatically, and they may be next. There may also be some of the smaller banks like Washington Mutual and maybe Wachovia and some of these other ones that have problems. But I think the real risk is overseas, and particularly in Europe. So if we have a problem here, even if Citigroup, which is a massive bank, goes down, the Treasury can step in and arrange a bailout, make sure that the systemic risk isn't realized. Now, the big problem in the world today, though, is big banks in small countries. And in Europe, there are many of them. So in particular, if you think about Belgium and the Netherlands, first of all, they have massive banks. And the one which has lots of problems at the moment is Fortis. So Fortis will come under scrutiny fairly soon in the next few weeks. Now you say, but isn't Belgium part of the EU? The answer is yes, And they have a memorandum of understanding about how things will be done, but they don't specify exactly how burdens will be spread out. And what that means is that if Fortis gets into trouble, for example, there's going to be a delay, and that's going to lead to this kind of contagion risk that we've been talking about. But the real country that is problematic, in my view, is Switzerland. They have two massive banks, which are UBS and Credit Suisse, and they have assets which are 6 times the GDP of Switzerland. UBS has lots of problems. You know, if you've followed the problems about the tax avoidance and so on, they have a lot of ethical issues there. They've also had insider trading scandals in various countries and so on. They've had a lot of problems with subprime loans and a lot of problems with their risk management systems. Now, if they have a big problem, the Swiss government cannot afford to bail them out. And that is where the problem comes, because if they go down, the kind of sequence of events that the Fed talks about when it justifies rescuing Bear Stearns, that can happen in real time in Europe and then spread to the US and to other parts of the world. And I think that's the real danger. Now, hopefully it won't happen. Hopefully Jeremy's right. Everything will now calm down. But I think that's the worrying thing. What Joe was talking about is also very worrying. Property prices have got a ways to go, in my view. If it spills over into commercial property, that's a big problem. And then we get into the other major problem facing us, which is the feedback effect. All this is assuming that things don't go too bad in the real economy. Things haven't gone too bad yet, but they may well do if people start losing their jobs, if we have a lot of more disruption in the financial system. And that's the real worry. Now, Jeremy mentioned Japan. My own view is Japan actually didn't do too badly. You know, if you want to look at the way not to deal with this, the ultimately bad example is the Great Depression, when unemployment went to 25% or so. And it lasted for many years. Now, if you look at some other instances, if you look at Asian crisis, again, or you look at the Scandinavian crisis, they got into deep recessions. Japan didn't. It stopped growing, it had the lost decade, but it didn't have ordinary people suffer great pain. Now, you know, the interesting question is, what are the feedback effects? How far is this going to spread? And where are we going to be 5 to 10 years from now?